Just introducing myself, my name's Robert Shelton. I'm the Managing Director of the company. Most of you have met me before, seen me present before. Sorry, it's the same joke. Also in the office today here, we've got Melissa Healy, who'd be known to many of you. She's been a speaker for a number of our boardroom briefings over many years. Next to her, our newest director, Graham Brown. Graham's been with us now for 11 months, having come from another firm. And this is like your second or third boardroom briefing that we've inflicted on you. So Graham does business services and tax and advice and all this good stuff, just like the rest of us. And down the end of the table is Jerry. Jerry is our newest recruit. He's a fully licensed financial planner. And Jerry's joining our financial planning team, joining Bob and Inglu as our financial planning capability. So please have a chat with Jerry if you need financial planning advice. We've now got two resources in this space. We have previously had one that was completely overloaded. Very shortly, we're hoping to have two that will be overloaded. As we do.
I've got him racked and stacked already.
Yeah, which is good. So I did say to you as we were sort of beginning, the intention here is to have you well and truly out by probably 6:30, not 7:30, when the budget in reply speech is on. The budget in reply speech is one of the most boring speeches that happens in the federal parliament each year. Nobody pays attention to it. And all the people who aren't paying attention to that are probably the same people who didn't pay attention to the budget itself. Right? But you're here, so you're obviously a little more excited about what happened in the budget. Budgets used to be really exciting when they were Paul Keating and Peter Costello. They've become more political and yet less technical in recent times, and more stuff is issued by way of press release or leak in advance of the budget. But that's okay. There were still some issues and some little hidden nuggets along the way. So as of the last few years, we're going to work through tax and consequences for individuals, for business, for superannuation, and then at the end, just talk a bit about tax planning and what these ideas will do. Now, that'll also emerge along the way as I work through things, but we'll also have a bit of a focused session on that toward the end. So the thing with budgets is there's always going to be a couple of questions that you should ask, all right? What will actually get through Parliament? Okay, what gets announced in the press releases, in the budget papers, and what actually becomes final law are not always the same thing. And sometimes they disappear into the ether, sometimes they morph dramatically, sometimes it takes a while. Okay? And even if it does get through Parliament, what is the start date for the announced changes? Start dates go in the budget papers, but then you discover actually it doesn't start until royal assent, or it doesn't start until some other date. Sometimes it's even backdated. You always got to be careful of those things. So what gets announced and what finally becomes law is frequently different. Okay, so kicking off with individuals. There were some things announced in the budget, and there were some things where there was enormous silence. And I was waiting for it and it didn't happen. And I thought, did I just sleep through it or investigate my eyelids? But no, it wasn't there. It's sort of like, you know, the other day upon the stair, I saw a man who wasn't there. You know, he wasn't there again today. I wish he'd go away. That's the old poem. We'll come to that in a moment. But various thresholds are being indexed. So the low income Medicare levy thresholds are all being adjusted. Various Centrelink payments are all being adjusted. Not going to go through that in a lot of detail. Most of our clients are not eligible for a lot of that stuff, and it's pretty mechanical. It's not going to be very visible. What will be visible is that the low and middle income tax offset has not been renewed. It simply wasn't there. It was, again, no mention of this tax offset. This tax offset was very popular because you only got it when you lodged your tax return. It wasn't part of the fortnightly tax scales. And when you lodged your individual personal tax return, it was up to a $1,500 tax benefit that you frequently got in one large refund check. And if everything else during your year was absolutely stable and you were just on flat salary, no interest, no income, no deductions, no nothing, you could lodge your tax return for the previous couple of years, COVID benefit, $1,500 tax refund. All right? It's not being renewed. They were silent on it, which means that the incentive to lodge your personal tax return went down by $1,500. Okay? All right? There is still a small incentive if you're at the very low end of the income tax scales, but that main one is gone. Right? So the bad news here for the evening, if you're used to coming in and you say, oh, the accounts are great, there's a $1,500 tax refund, this year it's going to be zip. And that's not the accountant's fault, that's the government's fault because they haven't kept this little benefit going. Right.
Did
So-
you extend it?
So yes, please don't blame us. Stage 3 tax cuts did not get a mention by the Treasurer once on the entire budget day, not during the lockups, not during the interviews. It was kind of, and another commentator said, it was the Voldemort of the budget. You know, he whose name shall never be spoken. The Treasurer completely failed to mention the stage 3 tax cuts for 24 hours. This is impressive, right? So they didn't make any mention at all, but they're still there. And they're legislated, they are actually law to start on 1 July 2024. So all of the media carry on and all the noise about the stage 3 tax cuts, we've got another 14 or 15 months of them doing that again before we find out if they're actually going to happen. Right? So what are the stage 3 tax cuts? Over here on the right-hand column of this table is what from 1 July 24 is currently in the law, unless the government changes it, will happen. And that is that we go to having basically 3 positive tax rates. So the first $18,000 over here in the right-hand column, first $18,000 you earn is tax-free. Then from $18,000 to $45,000, you're only paying 19%. And then the change is that from 45 all the way through to 200,000 in taxable income, you're paying a flat rate of 30%. That is an enormous middle tax bracket, right? Okay. And once you're earning over $200,000 over in this right-hand column, you're then paying 45%. Now, to each of those rates, you've got to add the 2% Medicare levy, so it's really 2% more than that. All right. But only 3 tax brackets. Right? Where are we at the moment? Current financial year in this second column from the left. You can see there's various different rates of 19% to 32% to 37% to 45%. Okay, so fairly complex, and nothing is changing in the next financial year. Right? So financial year that starts on 1 July, no change. No personal tax cuts, got to wait another 15 months for those. Right? Now, whether you view those stage 3 tax cuts as a good thing or a bad thing or what they are, remember that does say the fact that they're called stage 3 does imply that there was probably a stage 1 and a stage 2. Right? And there was, and stage 1 and stage 2 tax cuts were heavily skewed to the lower income space, right? Lower income brackets. The stage 3 are skewed to the higher income brackets. Right? You can make your own moral judgments as to whether that's good, right, and appropriate or otherwise. Not here to comment on that, but I do just comment that there's a very short memory. Stage 3 does imply there was a stage 1 and a stage 2, and absolutely those were aimed at the low income spaces. Remembering that they were announced 5 or 6 years ago and implemented on stage 1 and stage 2, 5 and 4 and 3 years ago. Okay, so that's what's happening there. But the short story is nothing is changing on personal tax scales on 1 July. Okay. We're still where we were. Okay. So what does all that mean? On the personal tax front, it was pretty boring. Right? There's not much in this year's budget. And the exciting thing is that's the same slide up to that point as was last year. There actually wasn't much in the personal space. However, there are some other things we're going to talk about super later on. So I've just put some comments in there, but we'll come back to that when we get to the super section. Okay. Let's talk about businesses. I know there's some business people around the table. The 2 big exciting things that you're supposed to be going, yay, yippee, this is fantastic. On the 1st of July, we're allowed to have an instant asset write-off of $20,000 for plant and equipment, depreciable items that we buy from 1 July onwards. Okay, and you go $20,000, right? For the last couple of years, because of COVID, you've had a massive instant asset write-off. Basically, any number you want. If you're a small business, you could write it off. It was the instant asset write-off a few years, courtesy of COVID. Okay, we don't have COVID anymore, apparently. We're certainly not getting that benefit. And the actual legislation says these extra benefits wash out on 30 June. And from 1 July, we revert to normal. And normal would be a $1,000 instant asset write-off. So all you business people, you're super excited that anything that costs more than $1,000, you're going to put it on your depreciation schedule. You're keeping an eye open for that. So every laptop, every computer, over $1,000, bang, depreciated over time. The government is hoping that where business owners are going to say, hey, this is really good. We're getting 20 grand instead of one, but we're actually getting 20 grand instead of the last 3 years where it was almost an infinite number. Okay? So whether you see that as a good thing or a bad thing depends on how far you're willing to look forward. This instant asset write-off, you have to be under 10 million in turnover, right? And if you are, you can get your instant asset write-off. That's only for the 12 months. Unless they extend it again in 12 months' time, you'll be only instant asset write-off of $1,000 again, which is crazy for small business. But anyway, they haven't actually used the $1,000 for about 10 years now. It's been in the legislation for about 10 years, but they've had higher numbers that they keep extending year by year by year and adjusting and mucking around with. That's what it is. So temporary full expensing, which was the COVID measure, washes out on 30 June. So your first tax planning suggestion, if you're running a business online or in the room here, first tax planning is buy it before 30 June. Get the full asset write-off, especially if it's going to be over 20 grand. All right? Buy it before 30 June, get your instant full tax deduction now. Okay. There is a catch. All right? You do need to have your item, if it's a plant and equipment, depreciable item, it needs to be installed, ready for use to be able to count. It's not when you ordered it or when you put a deposit on it or when you finally paid for it even. It's when was it installed, ready for use.
Including cars.
And for cars, given that there's anything from a 6 to 18 month to 24 month delay, ordering your car now to get your instant asset write-off, unless you manage to score something that you can take delivery of in the next 6 weeks, which would be a bit strange, you're not going to get that instant asset write-off if you haven't, you needed to have ordered it 6, 12, 18 months ago. The most popular family wagon in Australia at the moment is the Toyota RAV4, 18 to 24 months delivery delay on those. Okay. So get it installed now if you can. The second one they announced last night, which is all new, and we go, oh, fantastic, this is great, a small business energy incentive. So if you're a small business, which is now defined as anything under 50 million in turnover, the definition of small business is a very moving target. It makes life complex for accountants. You get an extra 20% bonus tax deduction for electrifying your energy efficient devices. Right? So if you take a gas-fired device and you throw it in the bin, you can probably write off any depreciable value on that that's left, and you replace it with an energy efficient electric one, an extra 20% bonus deduction for what you spend. Spending is capped at $100,000. So therefore, if you spent $100,000 replacing all your gas devices with electric devices, you would get a bonus tax deduction of $20,000. And if you're a company, your bonus tax deduction of $20,000 at 25% tax benefit means you're actually getting a tax saving of $5,000. So it sounds really good, but when you do the maths and you bring it back, it's like, yeah, okay, nice, better than a kick in the head, but it's not really going to do a lot to change the universe. Okay. But they wanted to make big. So there was our announcements for SMEs. The small business energy incentive again is for only 12 months. That's all you get on it. We don't know whether they'll extend it or change it after that, but it is time limited and it hasn't been legislated yet. So we don't even know whether it's going to happen or not for sure. It's not terribly controversial. So there's your business announcements. Hope you're just quivering with excitement about this. You know, I can see the enthusiasm in the room here. That was it. There were some other detail things. These are buried away in the budget documents that you don't want to read. There's a lodgement amnesty. If you are behind in your business on lodging your BASs and your activity statements, they're giving you an amnesty to get up to speed. The amnesty is they're not going to hit you with a late lodgement penalty, but they are going to hit you with interest. Interest is always the bigger number. Hopefully none of you are in this case. One that also sneaked in, if you're buying your EV car, right? EV cars are exempt from fringe benefits tax at the moment. That was an announcement to encourage people to buy EVs. However, you have to have taken delivery by April of 2025. So you've still got a while and there is enough time to buy your EV and to order it and actually take delivery of it. But after that, they'll become taxable on the fringe benefits tax. All the ones that you take delivery before that, we understand, will be grandfathered, so they will keep their FBT exemption. But if you buy it and take delivery after April of 25, fully subject to FBT. Okay. And the tax office is working out ways to actually calculate what is the electricity cost of fueling your EV when you've got a solar panel on your roof and you're not buying any. They've done some work around that, which is making it easier for them to say actually no more exemption. We do have some clients who are quite excited about this. It is got some caps and one trick to it. The cap is it has to be under your luxury car tax threshold. So if you go to buy your dual motor Tesla with the ludicrous button, yeah, that's over the luxury car tax threshold and won't be eligible. But I can tell you from personal experience, the Mini Miner SE two-door electric Mini Miner goes like a cut cat, is great fun, right? And is underneath the luxury car tax threshold. And my wife and I fight over the keys for it all the time. The other trick to it is it says it's exempt from fringe benefits tax. You don't pay any FBT, but you actually still have to calculate what would have been the FBT, and you still have to report it on the individual who drives it or has it as part of their salary arrangements. You still have to report it on their salary arrangements. So you have to do all the work as if you were going to pay the FBT. You just don't have to write the check. Still totally reportable, just exempt from actually paying. Right? So that's a bit of a trick. But what they're trying to do is get people to buy EVs and particularly get fleets to buy some EVs. So we have a second-hand market, so the trickle-down effect supposedly happens and people get more stuff on that. All good. The tax office is getting the usual funding that they get every budget to chase the usual suspects, where they can get some more revenue by harassing more people into doing the right thing. Yeah, pretty normal stuff there. A whole lot of technical amendments to various other minor items and some big picture changes to the petroleum resource rent tax and so forth. None of our Canberra clients are into the petroleum resource renting arrangements, so I haven't bothered putting much detail in here. There's a bit of stuff about multinationals and taxing multinationals with alternate minimum tax. We don't have any multinational clients with billion-dollar sales. So again, I haven't put any of the detail in here. I won't bore you silly with those. I can bore you silly with what I have got without having to do that as well. And there's going to be some super changes which will impact strategy and thinking, particularly for businesses. So stay tuned when we get to super. Okay, so that's it. There wasn't a lot of excitement for business in this budget. Okay, let's just roll back. 14 months ago, there was a budget, the last budget of the Liberal government before an election. And there were March 2022 announcements. Those announcements from March 2022 are relevant now, but they have not actually been legislated yet. Okay. However, both parties have voted for this in the lower house. And because the Liberals proposed these things, it would be a bit strange for them to oppose their own measures in the upper house. So we expect this will get through, but we haven't actually seen the legislation go through and be approved yet. So what was announced last year, but still not yet law, external training courses for employees, you'll get a 20% bonus deduction. So that same 20% bonus that we talked about before, but in a different context, where you send your employees to external courses delivered by an Australian approved training organisation, an RTO, can be online or in person. The costs will be only up until 30 June next year. All right, so you get a little while, and you get that 20% bonus in your 2023 tax returns for expenses that you have already paid. All right, so again, there'll be something in there. All right, pretty good stuff. The benefit has been deferred, but we will actually get those benefits when we lodge your 2023 business tax returns. Okay, and there'll be a box in there for us to fill in and put some extra numbers in, assuming the legislation does go through. Okay. Digital adoption costs, and again, there is a bit of information as to what that might be, but this is another reason to think about doing any computer refreshing before 30 June. You might get your instant asset write-off, especially if you do more than 20 grand worth of computers. Might be a very expensive computer if you do that, but whatever. If you digital adoption costs, 20% bonus deduction again, websites, cyber, hardware, cloud subscriptions, anti-hacking, right? All those sorts of good things. Incur your costs, but only until June this year. So note the timing. The external training costs have got another 14 months. The digital adoption costs have only got another 7 weeks. Okay, so a bit of a difference. Okay, and again, you get to put a 20% bonus in your tax return in due course. What was also announced in a previous budget was that there would be special rules for patent box companies. That's been dispensed with. That's also been completely silent, and it's quietly dropped off, and they've said it won't be proceeding. Right. So we do have some clients that are actually into inventing various scientific and other good stuff. They're a little bit excited about that. They don't need to be a little bit excited about it anymore. So sometimes you've got to have a slightly longer view of what's this year's announcements and what's last year's announcements that haven't come through, and are they going to come through or are they not?
But is the patent box thing helping companies to invest in do research? Because there was one a couple of years ago that companies could claim as research and development.
Yes, so there's always been an R&D tax benefit.
Okay.
And they mess around with that quite regularly. There was no mention of R&D in this year's budget papers. Okay. So the existing rules we assume continue on that front.
Oh, okay.
But the patent box has gone.
Oh, okay. You pay the patent and you get tax relief? Oh,
Yeah.
Okay.
So you still get some tax relief for running a business that generates patents, but not what they were going to propose, which was a lot more generous. For whatever reason. Okay. Well, they didn't talk about, again, on the budget, no mention in the speech of tax rates because that was Voldemort. There is no changes to the company arrangements. Base rate entities, which is small businesses that are active small businesses employing people and doing real sales and so forth, are still at a flat rate of 25%. Other companies that might be just passive investment companies that don't have employees, don't do sales of real things, passive investment companies are at a flat rate of 30%. Okay, so pretty simple stuff there, and that's now been stable for a couple of years. Okay. One thing that, again, the Voldemort, this was not mentioned in the budget. Therefore, it's going to finish because they haven't announced it's going to be extended. There's a sunset date on business loss carryback. So this is the last year you get to use this, right? So if your company made a profit in 19, 20, 21 or 22, and it had to be a company, right? Or 23, or 22, and if your company then makes a loss in a subsequent one of those years, right? So you had to make a profit in an earlier year and a loss in a later year. This was a COVID thing with businesses being terribly volatile. The loss in the later year can actually be sent back to the earlier year, and the tax you paid in the earlier year can be refunded to you. Right? Normally, losses only carry forward in Australia. This was a rare provision where the loss could be carried back. Okay, we have had a couple of clients do this. It's fantastic for their cash flow. All right, but it is going to finish on 30 June this year, so there'll be no more loss carried back. If you're making losses from 2024 onwards, it has to be carried forward. Okay. There were a couple of little catches in there. If you made a profit in the previous year, you're having a loss in a future year. If you made a profit in the previous year and you paid a dividend, particularly a franked dividend, and you then do the loss carry back, the loss carry back would dilute your franking account, and you might not have enough franking account to have kept that dividend franked. And then it's just going to be, you know, there's going to be children crying and women running on the streets. It's just not going to be good. Right? So we don't let people do that. Okay, but that's a COVID benefit that's ceasing. So again, you need to listen to what's said in the budget. You also need to listen to carefully what's not said. For fringe benefits tax purposes, this has not changed. I've kept this in just as a reminder. You can buy one electronic device per employee per fringe benefits tax year. It is exempt from fringe benefits tax, and it's an instant tax deduction. Okay, so if you need to equip your team with laptops or with mobile phones or personal digital organizers and all the various variations of that, one per employee per FBT year, instant tax deduction, no fringe benefits tax. Knock your socks off.
As long as used.
It does have to be used for business purposes.
Not give to your spouse. Yeah.
But I do have one of my consulting clients. Each year she buys a new laptop, latest all singing or dancing model for herself. And the previous year's model goes to the teenage children. So the teenage children are always getting one that's only 1 year old, and each year buys a new one. It's a nice big fat tax deduction, and the kids are getting 1-year-old laptops. Unfortunately, she's got too many kids, so the oldest one's always getting a 4-year-old laptop, but so be it.
They just have to protest.
One of the things that did change was that if your company is doing the right thing under the occupational health and safety rules and you're buying rats, right, as in the tests, not as in the critters that eat cockroaches, the rats are exempt from fringe benefits tax. So knock yourselves out on that. And just a reminder, buy your EV before April and take delivery before April 2025 for your exemption on that. Jerry, you got a question there?
On the EVs, I know in the past that April 2025 date was for the hybrid EVs. So basically this is saying not only will the hybrid stop at that time, but all EVs will, the fringe benefit will.
That's the announcement. Okay. Be interesting to see whether the Greens, and politically, it'll be interesting to see whether the Greens back this because they see it as an attack on the wealthy, right, an exemption for the wealthy, or whether they say, no, we want to keep the exemption because it's converting people into having more greens and more green vehicles, right? And they're going to have a pick your poison moment, and that will be interesting. I think we already know which one they'll lean. All right, so the big headline that wasn't in the newspaper on Wednesday morning was no changes to super. All right, that should be the headline. I've been doing this now for, I'm not going to say how many years, way too long. Been a budget tragic forever and a day. And it's always been wake up the next morning and look at what they're doing to super and groan and think about how the hell we're going to work that out with the clients and what the technical changes are and who it affects. And it makes our heads and eyes wobble. There was no mention of superannuation in the budget beyond the thing that already leaked 3 months before that. So the big headline for Wednesday morning was actually no changes to super, which was like, ah. Now, what did they do though? Okay, what they have announced pre-budget, and they leaked it to the press, is one of the most poorly designed but politically good superannuation taxes ever seen. And this is going to capture the attention of 32 of our clients that we know about. And it's for people who have an individual super fund balance that exceeds $3 million. Right? That $3 million, and yes, some of us are going, I wish, I'm only dreaming. Yes, I see the look on your face there, Lisa. That'd be nice, wouldn't it? Right? $3 million individual super fund. That $3 million cap is not indexed. So over time, more and more people, just by dint of investment earnings and being slightly younger and chucking money in, will go into this $3 million space. And so we already know we have 32 clients just on an initial run through that are impacted by this.
That's just our SMS.
Yeah, just our SMSF clients.
Our employee clients who might have other other super funds that we don't monitor.
So this one's going to be interesting to see if it emerges the way they've announced it, because the announcement looks good on the surface and is utterly appalling underneath. The appalling element is they will be taxing the growth in value of your fund, regardless of whether you have sold the assets or not. Okay, so if your fund goes up in value because the share market's having a fantastic time to 30 June, and 30 June is the reporting date each year, and that growth takes you above $3 million, tax office says, that's fine. The amount above $3 million times 15%, here's your tax bill. And they will send the tax bill to you personally, right? You can ask your fund to pay that tax bill, but the tax bill is sent to you personally. Right? And you think, oh, that's all right. If my fund's gone up in value, yeah, I'll pay a tax bill, or I'll get the fund to pay the tax bill. On 30 June the next year, if your fund has gone down in value and dropped below $3 million, or it's merely dropped below the number that was the previous June, you don't get a refund. And share markets do this. They're very volatile. Market values can be very volatile. Another situation, your super fund goes above $3 million, you pay your 15%, and you inconveniently and rather unhelpfully die. Your super fund value is paid out to somebody else. Right? Your value is now zero. You don't get any refund or anything. It got above $3 million. That's just it. You have one large asset in your super fund. Your one large asset goes up in value, And then if something goes wrong, you know, there's a flood or a fire or a famine that impacts on your property, typically commercial property inside a super fund, right? The value goes down. There's no refund of the fact that you paid your 15% tax while the value was up. Okay. Now, and if your value went up on the strength of one asset, and you either sell that asset or it goes down in value, will the rest of your assets in your super fund be sufficient to make up and to bring you back above that $3 million to make up for the fact that you'd paid some tax on it? So there's some design problems in this. This is one of the very, very few, almost no federal taxes that tax an increase in market value without the underlying asset actually having been sold.
It's also a cash flow problem.
It's a cash flow problem. I'm going there next.
For one asset and your asset's gone up in value, you get hit with a tax bill, but you've got no cash to pay with it because you haven't sold the asset yet. So it's
very
it's a
poorly
real mess.
designed. Yeah, and the cash flow impact on taxing uncrystallized gains might well be that some people are forced to crystallize a gain in order to pay the tax. And if you happen to have a super fund that's very heavy in one asset, that asset that's performing brilliantly might be the one that you have to sell in order to pay the tax on its performance. This particular superannuation tax is going to crash into the National Farmers Federation for farmers that have put the family farm into their super fund, right? And they will have a very asset heavy, single asset heavy, typically super fund. Values are going up, particularly given that it's been raining. Farm values look well. Assets are going up because land is scarce and the land gets rezoned to being residential. And so your $2 million farmland gets rezoned to being residential. Now it's worth 30 million. Right? There's going to be issues in here. The best chance of this crazy proposal being shot down is actually the National Farmers Federation, because if you want to get a tax change, you just got to get a farmer to have a whinge about it. And that seems to be the effective process. Don't ask me why. This doesn't start until 1 July 2025, if it starts in the current form. We do have clients that are already thinking about, do we want to keep our balance above $3 million? I've got one client we had a conversation with last week. Their balance is $3.4 million, but they actually do need to do $500,000 worth of renovations to their property in order to make it more appropriate for their retirement years. And they're talking we could sell a personal rental property, we could sell a personal share portfolio, and look at it, just take $500,000 out of the super fund. They're eligible to, and they can stop this fuss. Okay. So that's not going to be appropriate for everybody. There'll be different strategies for different people, but taxed on uncrystallized movements in market value, this is bad.
Don't do anything until it's law.
Yeah,
Or much closer
Gary?
to July.
that was my question. This is not law yet. This still needs to be passed for them to actually do it.
Correct. And we've got plenty of breathing space. Every accountant, superannuation fund manager, every technical person is saying this is appallingly bad policy. However, on the other side of the ledger, it's really, really simple for the government to implement. It's cheap for the government to implement because they've already got the administration process to do it, right? And it's an easy political sell. We're only hitting the rich people who've got over $3 million. It's only 82,000 people, and those 82,000 people are never going to vote for the Labor Party anyway. Right? So you're going to have good politics crash into bad administration. And my observation is usually when that happens, the bad administration loses and the good politics gets a win, and we end up with bad policy. I'm just a cynic. So poorly defined, and even worse, if you're on a defined benefit pension, you know, our public servants in Canberra who have retired on $150 and $180 and $200,000 lifetime indexed guaranteed pensions, what's the value of the underlying asset that is feeding their pensions? How is that taken into calculation in these? And they have, to put it technically, no clue as to how they're going to work that one. Right? They've said they're going to consult, which is clue for, don't know. All right.
Don't hold your breath. Just be patient.
Yeah.
Wait to see if that one comes
Watch
through
and
and if
see.
so, what brings up there.
It's a mess, but it's a mess that's politically very savvy.
Do you think that 12 months from now, we'll have a situation where a lot of people start flooding the market with properties that they have in their submarine super funds and so forth, just to try and get it?
It's possible.
Yes, now.
It's possible. Okay. All right. One of the things they didn't announce, again, is silence, but silence has a consequence. If you have a super fund and you're eligible to be at pension age, for the last few years, courtesy of COVID, in this middle column, you've had a lower rate of compulsory pension payment each year. All right. So it was discounted by half for the last few years. And you can see those 2, 2.5, 3, depending on how old you are, the required minimum pension was set at a lower percentage of your account balance. Going forward, from 1 July, the minimum pension returns to the default levels, which is this right-hand column of the table. And in the right-hand column, so your minimum pension for somebody who has started a super fund pension under age 65 from a private sector super fund is set at 4%. It's been 2% for the last couple of years, it's 4%. That's going to have a cash flow impact. Some self-managed super funds are going to have to make sure they've got more cash available to pay the minimum pensions going forward. Okay. And you can see the older you get, the higher the minimum pension becomes. Right? Those drawdowns are returning to their norm. Those percentages were set about 10 years ago, well, even 15 years ago. They've been changed occasionally as markets have had their conniptions, but that's the default from 1 July. If you have a self-managed super fund online or in person here, and you're in pension phase, recognise that your super fund needs to have more cash available to pay pensions than what it did for the last couple of years. Okay, previously announced things, just to sort of return and go over a few things. To put new money into super, you can do it from 67 to 74, and you don't have to pass a work test anymore. Right? However, if you want to claim it as a tax deduction, you do have to pass the work test. Right? So if you're an employee and your employer is paying it for you, that's fine. Presumably you're passing a work test by default by being an employee. Right? But as a person, might be semi-retired or fully retired, but you've got some extra money from an inheritance or somewhere, you've got other personal income, you want to claim a tax deduction for the super over those ages, work test applies. Got to show that you can do the work test. Work test, 40 hours of work in a 30-day period done once during the financial year. Right? So it's not that hard to do. If you are downsizing, right? If you are downsizing a house from a big house to a small house, the original announcement of the downsizing contribution was you had to be over age 65. Then they made it age 60. Now they've made it 55. Okay, so you can do that. For people with over $3 million in their super fund, they're actually doing the opposite. They're selling their mansion, they're taking their money out of their super fund and they're upsizing and putting it into the biggest tax exempt asset you can have, a main residence. Right? So it's probably going to feed the upper end of the housing market. That might be good for architects. Okay, but you can downsize and stick it in super, or if you've got over $3 million, you upsize and stick it in your exempt main residence instead. Work it out. For businesses, this is going to have an impact on 1 July, and you'll need to talk to your bookkeepers, online businesses, in the room businesses. On 1 July, all of your people got a 0.5% pay rise. It's in the form of a superannuation contribution increase. Right? Thou shalt have no choice. Thou shalt do this. Right? You will not be able to say you weren't warned. That is simply going to have to happen. Check with your payroll software that it is doing this properly. Okay.
Xero and hopefully MYOB will do that automatically. Yes. Like double check to make sure that they have.
So some of the software may do that automatically, and you may just notice an increase in your superannuation payment going out each month or quarter, but it's going up. Always worthwhile noting that into your conversations with your team members. They don't respect their superannuation, but it is an additional cost the business is wearing. Super guarantee charges being applied to pays below $450 a month. That's been the case for a while. Prior to this, we had 20 years where if you were under $450 per calendar month, there was no SGC obligation. That's been abolished. Make sure your payroll systems have seen that, particularly if you're using casuals and part-timers. Right? And they've said, this is an announcement, but it doesn't come in till July 2026. So you've got some time to work towards it. And this is pay the super when you do your employment payroll. So if you're paying your people fortnightly, your super is going to be sent to the super fund for those individuals fortnightly. Weekly, fortnightly, monthly, whatever your pay frequency is, super goes out on the same time. This is all part of the single touch payroll, or STP, because accountants need more acronyms. STP, single touch payroll, means as soon as you do pay, your software is reporting it to the government. And now they say, oh, well, now that we know what the pay is going out every week or fortnight, we can also do super the same way. And this is the thin end of the wedge. Eventually, they're going to say, well, if you're paying the net pay every fortnight and the super every fortnight, why don't we get the PAYG withholding every fortnight or week as well? Right? So that's going to happen. It's inevitable. Keep fighting and whinging and bitching and moaning about it for as long as you can, but recognise it's a losing fight. Okay. And for those of you playing in superannuation, just for the sake of completion, there's a thing called NALI, non-arm's length expenses. So if your super fund doesn't pay you because you're the architect and you redesign your home for free, your rental property, not your home and your super fund, your rental property in your super fund, and you redesign your rental property in your super fund for free, that would be a non-arm's length expense because your firm or yourself should have charged for it. And therefore the tax office says you've now polluted your super fund. We want to hit you with a higher tax rate. The original proposal was that do 5 times the avoided expense. Now it's 2 times the avoided expense. So you should feel happy about this, apparently. Yes. So don't get us started on that. Okay. Deductible contributions. Still $27,500 this year and next financial year. It may go up to $30,000 for the following financial year, but we're at 27.5 this year. We're at 27.5 for the next financial year that's going to start in 7 weeks' time. All right. All sorts of other changes in there in terms of you still got to have the right thing. If you're doing salary sacrifice, your salary sacrifice would have been calculated on your salary at 10.5%. From 1 July, it's going to be your salary at 11%, and you're only going to do salary sacrifice for the top-up differential. So everybody who's doing salary sacrifice in super, every single one of those are going to have to tweak their salary packaging calculations. All right. Pretty standard stuff. Okay. Non-concessional contributions limits. There is some strategies buried away in here. At the moment, your non-concessional, which means money you're putting into super for which nobody's claiming a tax deduction, is 110,000 per annum, or if you're eligible, you can take this year's 110, the following year's 110, the 1 year after's 110, and put in 330 in one go. Presumably you won lotto or something. So you put in your 330, but if you do that, of course, you can't do any of this kind of money for the next 2 years because you grabbed those limits and you used them up. Okay. You can only do that if your total super balance, TSB, if your total super balance is under $1.9 million next financial year, right? And the current limit is $1.7 million. We expect that 1.7 will be indexed. It's fairly clear that it will be. So if you're sitting at $1.6 million today, you think, well, hey, I want to chuck in $330,000. A, I'm available for adoption because you clearly need, a strategy there. You can't do 330 when the limit at the moment is 1.7 because you've only got room from 1.6 to 1.7. If you wait till July, 1.6 to 1.9, maybe you can do 300,000 there. So there's some timing strategies that we can play with in this space. Okay. All right. Worth looking at. Total super balance, index is increasing, 1.9 million. The other one that's happening is there's a thing called a transfer balance cap. It has the same number, but it's actually a different dynamic. The transfer balance cap caps the amount of money that you can have in pension phase inside your super fund. Transfer into pension phase. So you could have a super fund that's got $2 or $3 million in it, right? But the maximum amount that you can put into pensions is capped at the moment at 1.7. We're expecting that will be increased to 1.9. Right? It happens to be the same number, but it's got a different dynamic attaching to it. Okay? So those people that they're talking about that have got $3, $4, and $5 and $10 million super fund balances, the maximum amount they can have in pension phase is this 1.7, 1.8, 1.9. Right? The subtle difference is when they increase the total super balance, which was the previous slide, everybody gets room to have a look and see, can they shove some more money into super? When they increase the transfer balance cap, pension cap, it's calculated on a percentage basis. So if you've used up your $1.7 million in pensions, that's 100% of your cap that you've used up. When they increase the cap from 1.7 to 1.9, it doesn't matter because you've used 100% of the cap in a previous year. There is no additional cap for you. So the transfer balance cap is converted into a percentage, whereas the total super balance is held in hard dollars. Right? A subtle difference, just to make life complex for financial planners and accountants and people trying to track this stuff at home. To say nothing of the fact they use the same number for two completely different purposes. Okay. A lot of strategies around that. We're already having conversations with clients around year-end planning, starting pensions now, starting pensions in July, and just, do we wait in order to capture a bit more into this space? So that was the budget, and that was the things that were and were not announced in the budget, because sometimes the silencers yell things louder than what you think they do, and you might have noticed that a lot of what I put up on screen was actually what was not said, because that meant things were dying or not proceeding or not being extended. Right? You've got to read carefully to look at some of these things. Just as a generic statement, we'll go through fairly quickly some fairly simple tax planning ideas. Here's free advice for everybody online and in the room on how to just make some sensible stuff. The first thing that we're going to say, and I've said every year for the last 20 years, don't let the tax tail wag the commercial dog. If it's a bad idea, tax will not make it a good idea. Right? Okay, I've been doing this for a long time now. I have never seen tax make a bad commercial decision good. It sometimes makes a good commercial decision slightly less good, or even significantly less good. And sometimes it makes a good commercial decision something you should do in a different way. But if it's a bad commercial decision, tax will never make it good. Okay, so simple strategies. Deferring income. If you can push income, particularly in May and June, into the next financial year, then you delay the tax on it for another 12 months. Whereas if it lands in this financial year is about to close, you can have tax on it in this financial year. So if you have discretionary income where you have got the ability to move at the timing, private company dividends, our clients that are running private companies, maybe you need to pay a dividend before 30 June, maybe you should pay it in July. Right? Push it into the next financial year. With the stage 3 tax cuts being 1 July 2024, you might even want to push it out by 13 months. Right? Obviously, that has an impact on your ability to live in the meantime if you need those dividends. Delaying bonuses. Pay a bonus in June, taxable straight away, pay it in July, get the money for an extra period of time. Simple stuff. Delaying your interest income. So if you have term deposits, don't make them mature in June, make them mature in July. Sit on the interest for 12 months and a bit longer before you have to pay the tax on it. Simple strategies. I've put on there for the sake of completion, don't invoice in June. Right? And in the words of one of my very long-term clients, if I've got a customer who's busting their ass to pay me the money, I'm going to take it when they've got it. Right? Not invoicing in June has cash flow consequences. You may never get paid if you forget to do it. On the other side of the ledger, the business clients want their tax deductions in June, so they want your invoicing. So it is there, it is a strategy, but it's often a pretty dumb one.
Messes up your books too if you don't sell it. Because then you've got.
Yep, you mess up your books.
You're missing income in one year and it flows through the next, and it confuses the counter buyers because they don't see a nice stable income.
Exchanging contracts after 30 June. Capital gains tax is based on the date of exchange, not settlement. I've been saying this for 20 years. I still have clients getting it wrong, including a tax lawyer. Said, oh, it's settled. And I looked at him and I said, do you listen to you? Oh, this is a tax lawyer who knows exactly what he's on about. He's still got it wrong. Okay, all right. Exchange, not settlement, determines which tax year it falls into. For businesses, buy your plant and equipment before 30 June, as long as it's installed, ready for use. If it's over $20,000, you can do it next financial year. Sorry, if it's over $20,000, do it this financial year, one in the next 7 weeks, if you can get it installed and delivered and ready for use. Otherwise, you've got a maximum $20,000 write-off next financial year. Superannuation for your employees. This is a huge timing problem. Right? Pay your superannuation in June for the employees, get the tax deduction in June. Have it accrued in June, but pay it in July. It is not tax deductible until the following financial year. Superannuation is tax deductible on a cash basis when it is actually physically paid. And if you're using the clearing houses that aren't the tax office clearinghouse, all the other clearing houses are saying we're so overloaded, you'll need to pay your June super in June, July. You'll need to pay it by the 15th of June. Okay. If you're using the ATO clearinghouse, you have a bit longer, but the private sector clearing houses, if you haven't paid it by 15 June, you may not have paid it to get the tax deduction. Okay. Go through and write off any bad debts. If there's bad debts in there, clean them out in June. Don't carry them on. If there's old stock and old plant and equipment, take it to the dump, get rid of it, put it out the front on the discount shelf, just make it go away. Use your fringe benefits tax concessions, buy your laptops and hand them out to the team as bonuses. And if you're on a cash basis, you can prepay up to 12 months worth of subscription costs and so forth. You can prepay that in June and you can get the tax deduction in June. And a training cost, absolutely. Get the bonus on it as well. Bringing forward deductions for individuals. I know there are a few individuals joining us today. Self-education expenses, membership, professional libraries, knock them all out, do it all in June, get your tax deduction for it now, prepay your income protection insurance or rental property expenses, make your donations, right? Biggest donations in June, get your tax deductions for your favorite charities, do it in June, not July. And if you have got room, topping up your super from whatever your employer has done, to $27,500 before 30 June, a top up personal tax deduction. Make sure it's actually physically paid. Tax officers putting out a whole lot of noise that they're going to crack down on rental properties. They're going to crack down on home office claims, particularly post-COVID. And is it a study or is it a home office? And what about your stationery costs and all that sort of stuff? Making a lot of noise about it. We'll have some information in the newsletter. Be aware of their noise. Heaven only knows whether they're going to actually be able to do anything about that. But the rental properties that they're aiming at are ones on Airbnb. And also they're getting now a dump of every investment property loan and they're looking for redraws. And if there was a redraw, it was probably to go and pay the kids' school fees or to buy the car or do something that isn't a investment deduction. And they're going to go and query every one of those redraws. That's going to put fear and trembling into a few people. Okay, if you have a family trust distributions, tax officers made a whole lot of noise about those. We'll talk about that again shortly. If you're distributing to children, healthy children under age 18, it's $416. It's been that number since 1970 something, hasn't changed. That's why I can remember that number. If you are making distributions from your family trusts, those distributions should be documented and minutes signed before 30 June. We're going through the process at the moment of mailing out our distribution minutes for clients for signing and talking to them about year-end planning where we need to change them. So review the accounts, see how they're traveling. Going to talk about a couple of things now. This is just for mention because each one of these topics could be the topic of a 2-hour presentation all by itself. They are hot topics and they are a bit grey because there's been a lot of noise about it and a bit of change in interpretation. So family trusts, discretionary trusts, there's a thing called section 100A, which says if you're making a distribution to person A, but you've got an agreement that person A is going to physically give the money to person B, and the only reason you're giving it to person A is they're in a low tax bracket, whereas if you gave it direct to person B and they're in a higher tax bracket, they say that's not effective. All right? They made a lot of noise about that. They took a case to the High Court and the tax office lost the case. But the underlying principle is still there. So there's a bit of noise about this. Just be careful around that. Talk to us if you think there's issues in there.
Funding cases giving money to adult children.
And not giving it to them.
Tax return, but obviously it's mum and dad spending the money. So some of you might have experienced gifting letters from kids to parents and that kind of stuff. So it's a big area of contention. So we just have to be that a little bit more careful in how we do things going forward.
Yep, thank you. Division 7A is a section in the Tax Act which talks about where a company lends money to an associated trust or to an individual. All right, we need to make sure Division 7A is attached, is dealt with properly. We do that properly in our firm. A lot of firms around town don't. There are announced changes to the law. The announced changes come from 2017 and they still haven't been enacted 5 years later. Okay. And particularly for professional practices, this is doctors, lawyers, architects, engineers, professional knowledge workers. There is an attack on how professional practices distribute their profits. And if those profits end up in low-income spouses and children, rather than in the hands of the person who earned it, there are some issues that the tax office wants to attack on that. Right? It's mainly targeted at the big end of town called KPMG and it's Young, Deloitte, and the very large legal firms, but it does leak down into we need to pay attention to this in smaller firms and small to medium space. So a bit of noise on that. Don't need to lose a lot of sleep over it, but it would be a good idea to have a conversation online in person. If you've got a professional services firm, It's worth looking at. The last thing that's causing a lot of noise at the moment is payroll tax. When you go into a lot of these medical offices around town, all over the country, you turn up and it's a big medical practice and they've got dozens of doctors, and you turn up and you see a doctor, may not even be the one that you're used to, it might be, doesn't matter. You see the doctor and they take your money and you think, good job done. Legally, those are structured that they're providing, the medical centre is providing a serviced office and the doctor is renting space. And the typical payment is the doctor gets 70% of the patient fees and 30% of the patient fees stays in the medical centre. That can be plus or minus 5, depending where you are. Okay. So what is legally structured is you are paying 100% of your patient fee to the doctor. The doctor is keeping 70% of that and is paying 30% to the medical practice, the landlord. Okay. That doesn't look like an employment relationship at all. But what's actually happening is you go into these medical centres or spectacle shops or some of the large corporatized dentists, a number of other places, and you pay your fee and the medical centre takes the 100% of your payment, subtracts their 30% retention and sends the 70% to the doctor, okay, or the ophthalmologist or the dentist or whoever it might be. So even though legally it looks like the doctor is paying rent, the money flow is 70% is being paid to what looks like a disguised contracting employee. In the case that went to court, this medical centre got this really wrong. They said, yes, you can rent your space from us, but you'll wear our uniform, you'll work 48 weeks of the year and you'll apply to leave for us before you bugger off anytime. Now, if it walks like a duck and quacks like a duck, you can't argue that it's a chicken. And that argument has now been litigated and lost. Payroll tax people have had a win out of it. There are medical practices all over Canberra, including one of our clients, where there's $3 million of back payroll tax at risk. All right, okay, that's before the interest and penalties on this. The understanding of how these situations work has changed. The law is the same as it has always been. There's been no change to the law, but the understanding of how it works and the modern medical practices have fallen afoul of it. Okay. Now, we all know the main reason why the medical practices collect 100% of the money and hand on only 70 was good risk management, because doctors are useless at paying their bills on time. We know that, right? So this was smart commercial arrangements, but it falls foul of the payroll tax rules. And there's now been cases in New South Wales, Victoria and Queensland that have all been lost. Right? The payroll tax authorities have all had a win on these things. Okay. So this is emerging as a major issue. There's a lot of very unhappy doctors around on this space, amongst others. Talk to us if you think you're in that space, and if you're getting close to payroll tax thresholds in any state or territory, pay attention to them.
Yeah, anytime you pay a contract.
Contractors are core. 1 July 2023, consider how your year-end planning. Can we stop from going into that top tax bracket? Can we throw some money out so that it turns up in the stage 3 tax cuts if they happen? Let's see if we can push it out a bit longer. Right. Negative gearing has been working for the last 100 years. I don't know how long, but it's worked forever. It still works. It's still the best tax planning strategy around. Right? Can you defer income into the stage 3 tax cuts? Just mentioned that. Can you work it so that you stay below $250,000 in taxable income as adjusted? That way, if you're below $250,000, you don't cop the tax office's additional tax on your super contributions. Right? Don't go over it by a few dollars. If you're going to go over 250, go over it by a country mile. Make it worthwhile, but don't go over by just a couple of bucks. And salary sacrificing, adjusting your super, remembering that we go from 10.5 to 11% SGC rate, so everybody's going to have to change super, as I mentioned. All right. Some pretty simple stuff. All right. What to do next? Just as I wind up, I'm sorry, gone a little bit slightly longer than I normally would. The best tax planning is done before the start of the financial year, not 6 weeks before the end of it. Right? Now, when they change things in budgets and so forth, we do these things so we do have a bit of a headlight to say, is there anything we can do in the last 6 weeks, 7 weeks before the financial year finishes? But the best conversation is, what's our strategy for the following financial year and the one after that? Right? So do that. And just a reminder, don't let the tax tail wag the commercial dog. If it's a dog of a proposal, tax is not going to fix it. Be always very careful about that. Yeah, okay. DFK Everalls, my 30-second sales pitch. We look after financial planning. We have a bookkeeping division. We have our wealth management financial planning division. Somebody just clicked off. We have finance broking and mortgage broking. We can look after your finance arrangements. That's what we love doing, helping our clients do better. We've been building better businesses since 1968. I wasn't around then, but Melissa was. We've been doing it since then. We have this joke. Melissa and I are actually born in the same year, so she's considerably better and younger looking than I am. All right, so how can we help you? Interim year-end planning, strategic. You can read the list on the screen there. You can read it online. You can read it here. I'm going to wind up now. For those of you online, thank you for joining us today. Hope you've enjoyed listening. Hope I haven't bored you too silly. For everybody in the room, please continue to have a drink, have some of the nibblies on the tables, ask questions of our fantastic team here. Anything you want, they'll ask. I won't answer it, but you can ask them. And have a good night when you leave. No worries.
Thank you.
Oh, there's a chat.
Oh, was it chat? No, I think it was earlier.
Same thing.
Yeah.
Okay, good.